All right, let's talk investing. If you've ever thought about putting your money to work, you run into a fundamental choice, a real fork in the road that shapes your entire strategy. Today, we're breaking that down, active versus passive investing. So let's get right to it.
You know, when you really boil it all down, the entire debate comes down to this one simple question. Do you want to try and outsmart the market with clever picks and perfect timing, or are you content to just be the market and ride its overall journey? It's a simple question, but man, it has some complex consequences.
So we're going to frame this as an investing showdown. In one corner, you've got the hands-on, active stock picker, and in the other, the steady, patient index follower.
All right, first up in the ring, our challenger, the active approach. Think of that super sharp fund manager you see in the movies, hunting for the next big thing before anyone else even knows it exists. So what's the goal here? Well, it's ambitious, and it's super clear. Beat the market. An active investor isn't looking for the average return. No way. They want a better return, and they believe they can get it by doing deep research, careful analysis, and using their own expert judgment to make very specific buy and sell moves. So what's the big appeal? Why do it? First and foremost, it's the potential for those higher returns. This is the main attraction, the chance to really knock one out of the park. Second, you get flexibility. An active manager isn't just locked in. If they smell trouble in the air, they can sell off assets and shift the strategy on a dime. And that leads right into the third point, risk management. A really savvy manager can potentially dodge a risky industry or a failing company, protecting your portfolio from the worst of the damage. But, and this is a big but, that potential comes with some pretty serious downsides. First, you've got higher fees. All that research and trading costs money, and those costs can really eat away at your returns. Then there's simple human error. The manager's judgment could just be wrong. I mean, it is incredibly difficult to be right all the time. In fact, get this. Study after study shows that over 90% of active fund managers fail to beat their benchmark, the very market index they're trying to outperform, over a 15-year stretch. And finally, all that frequent trading can create a bigger tax bill, which cuts into your profits even more.
And you should not underestimate those fees. They really, really matter. Just look at the difference here. Over decades, that higher cost for an active coach acts like a giant anchor, creating a massive drag on your growth. It's a huge hurdle that active managers have to clear just to break even with the market, let alone beat it.
Okay, so now for our second contender, and this one is often seen as the reigning champion of the modern era, the passive path. This approach is all about a totally different game, steady, consistent performance.
The goal with passive investing is completely different. It's not about trying to beat the market, it's about becoming the market. The whole idea is to simply buy and hold a huge basket of investments, like say all 500 companies in the S&P 500, and just match its performance over time. No crystal balls, no predictions, no guesswork.
And the strengths here are really compelling. Because you don't have a whole team of analysts trying to find the next big thing, the fees are incredibly low. And that is a huge, huge advantage over the long run. You also get diversification, like instantly. By owning a fund that tracks an entire index, you're not just betting on one or two companies. Your risk is spread out all over the place. And finally, you get consistency. You are pretty much guaranteed to get the market's return year in and year out. And that diversification is just so powerful. I mean, think about it. When you buy a passive S&P 500 index fund, you're not just buying one stock. You're buying a tiny, tiny piece of hundreds of America's biggest companies. So if one of them has a terrible year, who cares? You've got 499 others to help pick up the slack. Of course, there's always a catch, right? There are trade-offs. By definition, with passive investing, you are giving up any chance of outperforming the market. You've signed up for the average return. You also have very limited flexibility. The fund has to own every single company in the index, which means you're stuck holding the losers right along with the winners. And that also means you are completely exposed to market risk. When the whole market tanks, guess what? Your portfolio tanks right along with it. So, there you have it. We've met our two contenders, each with some real strengths and some glaring weaknesses. The question isn't really about which one wins the fight overall, but about which one is the right champion for you. So let's just put it all side by side. Active investing, you're shooting to outperform the market, but you're going to pay higher costs for that chance, and you're betting on a human not making a mistake. Passive investing, you're just trying to match the market. This gets you much lower costs and broad diversification, but you are locked in for the entire ride, both up and down. It's a really clear trade-off, right? Cost, control, and potential.
And you know what? That brings us to the most important point of this whole thing. There is no single best answer here. There's no magic bullet that works for everyone. The right choice for you really depends on your financial goals, how much risk you can stomach, what you're willing to pay in fees, and fundamentally, what you believe about how the market really works. So I'll just leave you with this one question to think about. When it comes to your money, your future, who do you trust more? Do you trust the skill and judgment of an expert manager to navigate the currents and find those hidden gems? Or do you trust in the long-term power and the collective wisdom of the market as a whole? The answer to that question? Well, that's how you'll find your champion.